That's probably why mine's not working.
Okay. All right, guys. Sorry about that. All right, let's get going. Unfortunately, we're having trouble connecting into our um, the charting on our trading systems this morning, so I don't think I'm going to be able to give you the charts portion. Well, let's get into the commentary side. All right. Last night's session in the States, we started out pushing up a little bit higher, kind of unconvincingly. Very surprisingly, our market and the European market were trading unbelievably well, and into the beginning of the U.S. session. Even though the U.S. market had only bounced 5-6 points, we very quickly rolled over from there. Trended down the whole first half of the U.S. session, kind of flatlined a little bit, tried to bounce, and then really failed it at the end. I think the end was actually quite telling. We started out essentially the year with 5 down days, which is definitely the first time we've seen that in a long time. The first time we've seen consecutive down days, in a long, long time. Not really led by a whole lot besides maybe the crude oil price falling, but I think there's a lot more to look at there than maybe meets the eye. The big thing I think really there is that we've got so much high yield debt that's attached to the energy sector at the moment, and the entire energy sector is really quite imploding on the back of that. You got things like certain of the natural gas and things that natural gas hasn't been hit that hard. It's also affected, obviously, because of the fact that it's an alternative. I've had a lot of the other same situations, but the bottom line is that you've got about 15% of the high yield sector attached there, and I think markets are really nervous that there's going to be some real carnage in that sector before things are all said and done. Couple that with what's going on in Europe right now, and makes for a shaky start to open the year. So, we had a little bit of data out yesterday as well. We had ISM non-manufacturing and factory orders both coming in a little bit soft. But other than that, it's really probably the sell-off in the oil price dropping $50, which is really a good thing in terms of, a boost for the global economy in the long term. But in the short run, shaking some guys out. All right. We look at Asia. Asia didn't really give us a whole lot of follow through after the second shaky day in a row out of the States. We did have Shanghai that was off about 1%, but the rest of the markets actually held up pretty well. Not a whole lot to go there to really drive markets, but we continue to see the same sort of stocks, a lot of the same stocks underperforming. A lot of the oil stocks, very heavy commodity stocks, continue to be under pressure outside of the gold sector. All right. Our chart of interest this morning is out of Charlie Bilello, 30-year yield testing all-time lows, and it's not just the U.S. 30-year; it's every yield across the globe. We've basically got Japanese 10-year yields hitting all-time lows. We've got German 10-year yield at less than 50 basis points, which is quite spectacular as well. Yesterday, that yield down 13.8%. We've seen it across the globe, and virtually anything that is not attached to emerging market debt. Even South African 10 years come down to 7.73, which is about 50 basis points lower than it was only a month and change ago. So really probably going to see lower before we see higher as well. So this is one of the things I think can be one of the best indicators for us to watch going forward is where these yields are going. Obviously, we're starting to see a flattening of the yield curve in the States with the shorter term debt starting to rise, the yields starting to rise a little bit, and we've got longer term yields that are actually coming down a little bit, and that's also a little bit worrying. So we'll continue to monitor that as we go forward, obviously, but this is all quite spectacular when you look at it relative to where the historical norms would be, because if you look at these kind of yields on developed market debt, you would expect us, if that was the only thing that you looked at and you looked at that as, in a place historically and you asked anybody in the markets for a long period of time where we would be, you'd say that we were in some form of global crisis, simply because yields are so low. And, that's really not the case. So that's what makes it for such an interesting story that's unfolding as we go forward, is because this is something that we've never really totally seen. Right. There's no corporate action to speak of today in terms of market data. We've got retail sales out of Germany at 9 o'clock. We've got unemployment change there as well at 10:55. At noon, we've got the unemployment rate in the Eurozone as well as core CPI numbers. We've got mortgage apps in the States today, ADP employment change, trade balance, and the Fed releases their minutes today as well. So there's not a ton to go on to job markets, but like we said, we're in the start of the year here. We've had a shaky start. This year we're going to see real volatility. So, one of the things that we've been talking about here as a group has just been to, maybe get square a little bit more often, because when you look at yesterday, for instance, we had a 1,000-point bounce, and there's no real reason that we get such a significant bounce probably on the day, but the day before we were down almost 2,000 points. So that kind of volatility, I think, is back, and it's probably going to be here to stay. So play it accordingly. That's probably going to be where the real opportunities are, to get your books square more often, and be ready to pounce on the opportunities when they come. Sorry I can't get into the charting portion this morning, guys. Unfortunately, our system is down at the moment, but tune in tomorrow. I'm sure we'll have it going again. Thanks a lot.